Now that we have reached the final sheet of the financial forecasting model, the executive dashboard. Now, this dashboard consolidates all the calculations from the previous sheets into a single management view. So instead of reviewing multiple financial statements individually, decision makers can quickly understand the company's projected growth, profitability, capital efficiency, and overall financial health from one place. In other words, this dashboard transforms detailed financial data into meaningful business insights. As you can see, the active scenario at the top, we can see currently active forecasting scenario. So in our model, the base scenario has been selected with an assumed annual revenue growth of 15%. So whenever I change a scenario in assumption sheet, every financial statement, including the profit and loss statement, cash flow statement, balance sheet, sensitivity analysis, and this dashboard updates automatically. This demonstrates that the model is completely dynamic and scenario driven. So, moving on to KPI cards. First KPI is the revenue CAGR 3 year. So, the revenue CAGR or compound annual growth rate, it measures the average annual growth of revenue across 3 years of the forecast period. So our model projects a CAGR of 15%, indicating consistent and sustainable revenue expansion rather than irregular year-to-year fluctuation. Moving on to EBITDA margin. This measures the percentage of revenue that remains after deducting operation expenses, but before depreciation, interest, and taxes. So our projected EBITDA margin is 26%, meaning the company retains 26 rupees of operating profit from every 100 rupees of revenue generated. A stable EBITDA margin indicates strong operational efficiency and effective cost management. Then there is a 3-year PAT total. PAT basically means profit after tax. So this KPI shows the cumulative profit after tax across all 3 years, all three forecast years. So instead of looking at annual profits separately, this metric measures the total value expected to be created during the forecast period. Now, under the base scenario, the company is projected to generate approximately 64 crores of cumulative net profit. Perfect. Moving on to ROCE, that is return on capital employed. This measures how efficiently the company generates operating profit from the capital invested in the business. So our projected ROCE is 35%, which indicates efficient utilization of both shareholder funds and borrowed capitals. Generally, a higher ROCE reflects stronger operational performance and better capital allocation. Moving on to revenue, EBITDA, and PAT trend. So below the KPIs, we have 3-year trend analysis. This chart compares revenue, EBITDA, and profit after tax over the forecast period. Now, revenue grows steadily from 115 crores in FY 2026-2027. Okay, this is the revenue. It grows from 115 crores in the year 2026-2027 to, as you can see, 152 crores by 2028-2029. As revenue increases, the EBITDA also rises from 30 crores to 40 crores, indicating that operating profits are growing alongside the business. Similarly, PAT, that's profit after tax, increases from 18 crores to 25 crores, showing that company is successfully converting its growth into higher shareholder earnings. Overall, the chart reflects healthy and consistent financial performance. Yep. Moving on to scenario comparison. Now, the second visualization compares cumulative profit after tax under three different business scenarios. The best case delivers approximately 74 crores of cumulative profit. The base case generates around 64 crores, while the worst case still remains profitable at approximately 52 crores. This comparisons help management understand the potential range of financial outcome before making strategic decisions. Rather than relying on one forecast, leadership can prepare for optimistic, expected, and challenging market conditions. So, moving on to top 5 risk factors. Now, as you can see, we have summarized the 5 most significant business risk identified during the forecast process. So, first is the revenue concentration risk. It is basically if a large percentage of revenue depends only on few customers, losing one major client could significantly reduce future sales and affect projected growth. Next is raw material cost inflation. So our model assumes that cost of goods sold remains stable. However, if commodity prices increase unexpectedly, production costs will rise, reducing profit margins and overall profitability. Then it's interest rate as risk. So if market interest rate increases, borrowing costs also increase. This results in higher finance expenses, reducing profit before tax, and ultimately lowering profit after tax. Fourth is working capital strain. So if the customer delay payments or inventory remains unsold for longer periods, more cash becomes locked inside working capital. Although the business may remain profitable, available cash decreases, potentially creating liquidity challenges. And then there is regulatory or GST policy changes. So, changes in taxation, compliance requirements, or government regulations can increase operating costs and compress profit margins. Therefore, regulatory risk is another important consideration while preparing long term financial forecast. So, to conclude, dashboard brings together every component of the financial forecasting model into one comprehensive management view. It summarizes business growth, profitability, operating efficiency, scenario analysis, and key business risk in a simple and decision oriented format. By combining different dynamic assumptions, integrated financial statements, scenario planning, sensitivity analysis, and executive reporting, this model provides management with reliable framework for budgeting, strategic planning, investment evaluation, and financial decision making. Overall, the complete end-to-end financial forecasting model for Avanta India Manufacturing Private Limited, demonstrating how financial data can be transformed into meaningful business insights that support informed and confident decision making. So, guys, thank you so much for watching this end to end financial forecasting analytics project. Throughout this project, we have built the dynamic three statement financial model, including profit and loss, cash flow, balance sheet, scenario analysis, sensitivity analysis, and an executive dashboard. I hope this walkthrough helped you understand not only how the model works, but also the financial concepts behind it. If you found it valuable, Just feel free to like, share, and subscribe for more data analytics and financial modeling projects. Thanks so much for watching. I hope you learned something from it.